Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. Today we're going to go back in history and take a look at previous bear markets that have occurred in recent financial history. But I want to specifically look at bear markets that have occurred around yield curve inversions in this video. The yield curve is the most inverted today since it was in the 1980s, and we are officially in a bear market ever since May of 2022. The SP 500 had a 20% drawdown, dipping into bear market territory. We're not cherry picking anything in this video, but really going back in history and comparing these bear markets that have occurred around yield curve inversions. We're going to take a look at the price action, the patterns that we've seen, the depth of the moves down, and also how comparable the macro environment currently is to those bear markets. And of course, we're going to take a look at what type of drawdown we can expect based on all this analysis. I hope you guys are going to enjoy this episode. If you do, don't forget to smash the like button as hard as you can. Now, without further ado, let's get right into it. So I want to start by taking a look at 2008, the most notorious and the most recent example of a bear market apart from COVID, which we are going to exclude in this video. If you look at the first half of the bear market in 2008 and we align the tops of the markets, you can see the price action was actually incredibly similar in the first half of the bear market. Now, very recently, back in December of 2022, we diverged quite significantly from that setup as the market actually rallied instead of going on a waterfall sell-off like it did during the banking crisis in 2008. Now, what did the macro environment in 2008 look like at this moment right here after the first half of the bear market was done? And we can go back to 2008 and take a look at what the Federal Reserve, the US Central Bank, was doing right here around in July of 2008. So 12 to 14 months after the top of the bear market. You can see this is the federal funds rate. It was declining significantly. The Federal Reserve was easing monetary policy very aggressively, and yet the market kept on falling because the unemployment rate, you can see right here in July of 2008, as we were getting in that second half of the bear market, people were losing their jobs. The economy was in free fall. We were absolutely in a recession. So right up until this very moment, the macro environment in 2008 actually looked very different to anything that we've seen today. Unemployment was rising and the Federal Reserve was easing monetary policy. Today, of course, we have a very strong labor market and the Federal Reserve is tightening monetary policy very significantly. Now, could things turn into a dynamic similar to what we had in 2008? That's a very good question, and I'd say absolutely. We're going to talk about that in just a minute. Now, let's take a look at the second bear market that occurred following a yield curve inversion. So in 2000, right here, you can see how the price action back then was almost an exact copy to what's been happening right now. Now, of course, the drawdown right here was a little bit deeper than what we had in June of 2022. But apart from that, you can argue it's been a very similar bear market. And in fact, we're sitting at around the same levels 14 months into the bear market to where we were during this bear market rally in 2001. And you can see that ultimately led to probably the most violent part of the bear market where you had the most significant drawdown. Now, if we take a look at the macro environment again, taking a look at those same components in the first half of the bear market leading up to around the same moment in the bear market after the first half of the drawdown, you can see what was happening to the federal funds rate. Monetary policy, again, was easing significantly in that period. And yet, if we take a look at the unemployment rate right here, well, it had been rising throughout the entire bear market up until that moment. So again, very different to what we have today, much more similar to the bear market that we had in 2008. Now, if you're wondering why we're looking at the federal funds rate and the unemployment rate, I would say that these are really the two purest representations of what the macro environment currently looks like. What does monetary policy look like? Is the central bank trying to stimulate the economy? And what's the labor market doing? What's the economy actually doing? Are people losing their jobs or are businesses hiring a lot of people? Now let's take a look at the 1990 bear market. You can see what it looks like right here. It already looks very different, but there was indeed a yield curve inversion in 1989 that was eventually followed by a recession and that bear market. So indeed, if we take a look at the price action, we compare it to today, 1990 looks nothing like today. There wasn't even a bear market rally. That was the bottom right here. So very short, kind of intense, but definitely not similar. And if we look at what the macro environment looked like back then, again, monetary policy. It was easing. The Fed was dovish back here. They were trying to stimulate the economy, and yet the unemployment rate was rising throughout this period. If you look at the actual drawdown in 1990, the unemployment rate was rising throughout that period. So not similar in any way to the bear market that we saw in 2022. Now the 1980 bear market, this was it right here. Again, very different to the other ones, and the yield curve was definitely inverted in 1980 and 1981. If we look at the actual price action, it doesn't look too similar. We aligned the tops. The price action wasn't exactly the same to what we had in 1980, but you can argue that we've seen so far quite similar drawdowns, and we're at around the same levels 14 months into the bear market as we were in 1980. We're trading at the exact same place. Now again, if we take a look at the federal funds rate around 14 months into the bear market right here during this rally, what was the federal funds rate doing? It was easing monetary policy very significantly. So again, so far, none of the bear markets that we've studied, 1980, 1990, 2000, 2008, none of them really have a similar macro environment to today, because in all of those instances, the Federal Reserve was easing monetary policy. And look at the unemployment rate, even in this first half of the bear market, the unemployment rate was rising. And so the market had already priced quite a bit of that right here. Now let's get to the most interesting part, and that is the 1970s bear market. Let's start with 1974, vicious bear market. If we compare the price action to today, you can argue it's very similar. Now we've had a slightly bigger drawdown in 2022, but again, we're trading 14 months into the bear market at around the same levels as 1974. Now following that small bear market rally right here, you actually had the worst drawdown in 1974, taking the market much lower. So again, getting that acceleration of the bear market downwards. You start out slow, you start out grinding down with a few bear market rallies, and then you get a larger capitulation move down towards the end. And if we look at the macro conditions, look at what was happening in this first half of the bear market, right up until that bear market rally that we just mentioned. While monetary policy was tightening, the Federal Reserve was raising their interest rate. And if we look at the unemployment rate throughout that entire first phase of the bear market, you can see right here, unemployment was low. It hadn't really begun to rise. Now you can argue there was a slight rise here, but what really took the market down in that second half of the bear market was the unemployment rate that started to rise significantly. So we only started to get into a real recession in the second half of the bear market. In April of 1974, that's when unemployment started to rise and the market started to capitulate as we were heading into a recession. So we can definitely argue that so far 1974 is quite comparable, both in terms of the price action, that's obviously a lot more subjective, but objectively in terms of the macro environment, we have monetary policy that's tightening significantly and we have the unemployment rate that's very low. Now let's see if 1969 looks anything like 1974 or if that bear market is also more similar to 1990, 2000, 2008. Now in terms of the price action, again, very subjective, but you could argue it's somewhat similar. The drawdowns in 2022 were a lot more rapid, whereas 1969 saw a slow grind down that eventually accelerated down. But objectively, we are again trading at the exact same level as this moment in that 1969 bear market. So in that sense, it's still quite similar to this bear market. And interestingly, if we look at the federal funds rate back then, guess what was happening between the top of the market all the way to around 12 to 14 months. Throughout that entire period, the Federal Reserve was tightening monetary policy. You can also see the unemployment rate throughout that entire first half of the bear market was incredibly low. The labor market was very strong in that first half of the bear market. Again, very similar to the type of environment we have today. And once the unemployment rate started to rise again, that's when you had the second part of the bear market that was a lot more powerful, a lot more painful to anybody invested in stocks back then. So if we have to categorize the bear markets that we've seen throughout history that have been accompanied by yield curve inversions like today, we can, in my opinion, identify two clear winners that are more similar to today in terms of what was happening with monetary policy and what was happening with the labor market in the first half of that bear market. And those were the 1974 and 1969 bear markets. If we look at what the drawdowns were on those bear markets, you can see here 3,000 points for the 1969 bear market and 2,549 points for the 1974 bear market. Now, both of these bear markets actually look quite similar in terms of the price action that we've seen. We're trading actually at around the same levels that we were trading at the same moment in those bear markets, and both of those instances were followed by much larger drawdowns in the market as we started to see the unemployment rate rising as we were heading into a recession. And we are positioning our model portfolio accordingly. Now, if you did enjoy this video, make sure to let us know by clicking on the like button. It helps us grow. It makes the effort that we put into making these videos worthwhile. Also, if you're interested in knowing how we're positioning our model portfolio for the macro environment that we expect this year, you want to protect your investments and maybe even benefit from the environment that we're going to see this year, we do have a free trial that you can take by clicking on the link down below. We have a notification system that will alert you whenever any changes are made, and we also actively track the performance of the portfolio that aims to systematically beat the SP 500. Now, that's about all I wanted to cover in this video. I hope you guys enjoyed. In the meantime, I wish you good luck on your trading and see you next time.